Hello everybody, here is the quiz review video for Chapter 2. It is on journal entries, T accounts, and making a trial balance. Let's run through and do a whole bunch of journal entries that a company would have in a normal business cycle. Our company's name is going to be Adams Family Counseling. So the first thing that we have is on September 1st, Adams Family Counseling's owner, Gene Adams, is going to contribute $42,000 of his own personal cash to the business, and he's going to receive capital in exchange. Let's do our 5 steps to recording a journal entry. Firstly, what accounts are being affected? Well, he's contributing cash, so the company's cash account has to go up, and in exchange for this cash, he's receiving capital. So Mr. Adams has to have more capital, more value in the business. Those are our 2 accounts being affected. What type of accounts are they? Cash is an asset, Adams capital is an equity. Are they increasing or decreasing? Well, cash is coming into the business, so the amount of cash the company has to be going up. Mr. Adams is increasing his capital because he is putting more value into the business, so that also has to go up. And what side do these increase on? Well, cash is an asset and it's going up, and assets always go up with a debit. Adams capital is an equity account going up. Equity accounts always go up with a credit. So we can say that the journal entry for this would be that on September 1st, debits always go above credits. We're going to debit cash for $42,000, and we are going to credit Adams capital for that same $42,000. In our description, we're going to say there was an owner contribution to the business. Next up, on September 4th, Adams Family Counseling is going to purchase $400 of supplies and $1,600 of furniture. These are both on account. So what accounts are being affected? Well, we got 3 things now. Supplies is being affected, right? We're getting more supplies. We're also going to have more furniture, but we're not paying for it now. It's on account, which means we're going to owe more money, which means our accounts payable, or our AP account, is also being affected. What type of accounts are these? Well, supplies is an asset, something we're going to use to make a profit in the future. As is furniture. Our customers have to have a place to sit. And accounts payable is money that we owe to other parties for things that we purchased in the normal course of business, which we just did. And since we owe to somebody else, that's a liability to our company. Are they increasing or decreasing? Well, we're going to have more supplies after the purchase. We're going to have more furniture after the purchase. And unfortunately, we're going to owe more money. So all 3 are increasing. What side do these account types increase or decrease on? Well, supplies and furniture are both assets, and we know that assets go up on the debit side, so they're both going to be debited. Accounts payable is a liability. It's going up, and we know that liabilities increase on the credit side. So our journal entry is going to have 2 debits to the 2 assets we're acquiring and 1 credit to the liability accounts payable that's increasing. So on September 4th, we debit supplies for $400, we debit furniture for $1,600, and we credit accounts payable for the total amount that we owe, which is $2,000. We purchase supplies and furniture on account. On September 6th, Adams Family Counseling is going to perform counseling services for the Pugsley family, and they're going to be paid $1,800 in cash. Ask yourself, what did we do to earn money, and how were we paid? Well, how were we paid? We were paid in cash. What did we do? We performed services. We provided counseling services to this family. So service revenue is the other account that is being affected. What types of accounts are these? Cash is an asset. Service revenue is a revenue account. Are they increasing or decreasing? Well, we're getting money from a customer, so our cash has to be going up. Our service revenue account tracks the amount of services that we did during the period. Since we just performed more of them, that also has to be going up. Assets increase with a debit, and revenues always increase with a credit. So our journal entry for this September 6th transaction is that we are going to debit cash for the amount of money we received from the Pugsley family, which is $1,800, and we are going to credit service revenue for that same amount we performed cash services for a client. Next up, on September 7th, Adams Family Counseling is going to acquire a plot of land for $21,000 in cash, and the company plans to build a counseling center on the land. Second line is important because this is land that we intend to use, so we get to classify it as land is an asset that we own. If we intended to resell it later, we'd have to put it down as an investment. That's a whole nother story for a different accounting class when that happens. But for this, to be able to put land on your books as land, you have to plan to use it for your own business, which we do. What accounts are being affected? What are we buying? How are we paying for it? We're buying land and we're paying for it in cash. What two types of accounts are these? Well, land, something we're going to use to help make money in the future because we're going to build this counseling center at some point. That's an asset. Cash, again, is an asset. Are they increasing or decreasing? Well, the amount of land that Adams Family Counseling owns is definitely increasing. The amount of cash the company has, however, is going to go down because they're shipping out $21,000 to buy this land. So what type do these accounts increase or decrease on? They're assets. Assets always go up with a debit and down with a credit. So our journal entry is a debit to land for $21,000, a credit to cash for that same $21,000. In our description, we can say that we purchased land for use in operations. Next up, on September 10th, Adams Family Counseling performed $1,600 worth of services for the Gomez family. The company billed the customer and will be paid at a later date. And that second sentence is important because we're not getting cash right now. We did the job, but we haven't been paid yet. We sent them a bill. They're going to pay us soon, but they haven't paid us yet. What accounts are being affected? Accounts receivable. Why? Because I said we're not getting cash right now. They owe us the money. We are eligible to receive money right now from the Gomez family because we've earned it because we provided those services. So accounts receivable is one account, but even though we haven't been paid in cash yet, we still know that we did the job, which means we get to recognize it as service revenue. What types of accounts are these? Accounts receivable, AR, is an asset. Service revenue is a revenue account. Are they going up or down? Well, the amount of money that people owe our company is going to increase after this because the Gomez family now owes us this $1,600. Revenue, the amount of jobs that we actually did this job, that is also going to go up. And assets increase with a debit, revenues increase with a credit. So our journal entry on September 10th is going to be a debit to accounts receivable for $1,600 and a credit to service revenue for $1,600. We performed services on account. Next up, on September 14th, Adams Family Counseling is paying for the $1,600 of furniture that we purchased on September 4th. So we owed money when we purchased this furniture, but now we're paying off our debt, which means we're not going to owe the money anymore. And since we're not going to owe the money anymore, we know that one of the accounts that's going to be affected is the account which keeps track of how much money we owe to other parties for general business purposes, and that is accounts payable. The other account being affected is going to be our cash because we're paying to get out of debt. What types of accounts are these? Accounts payable is a liability, because we owe somebody else something, and cash is an asset. Are they increasing or decreasing? Well, we're paying off this debt that we had to the company that we purchased the furniture from, which means our liabilities have to be going down. Likewise, cash also has to be going down because we are taking it out of our business and giving it to this company to get out of debt for this furniture that we had previously purchased. What side do these accounts increase or decrease on? Well, accounts payable is a liability, and we know that all liabilities that go down have to go down on the debit side. And likewise, cash is an asset, and it is decreasing, and all assets decrease on the credit side. So our journal entry on this September 14th transaction is to debit accounts payable for $1,600 and to credit cash for $1,600. We paid on account for previously purchased furniture. Next, on September 15th, Adams Family Counseling is paying the company assistant her $1,430 biweekly salary, and we're paying her in cash. So what accounts are being affected? Well, paying your employees is a necessary expenditure for business operations. Like, you're not going to stay in business if you don't pay your employees. So anytime you're paying for something that is a necessary business expenditure that you're going to pay repeatedly over and over again, it is an expense. What is this expense for? It's for our assistant's salary. So salaries expense is one account that's going to be affected. The other account, we're giving our assistant cash, going to be affected. What account types are these? Salaries expense is an expense account, and cash is an asset. are they increasing or decreasing? Well, salaries expense tracks how much we've paid in total to our employees during the period. And since we paid our assistant her bi-weekly paycheck, the total amount of salaries that we have paid to our employees has to be going up. Cash is leaving our company, going to our assistant, has to be going down. For step 4, salaries expense is an expense account and is increasing, and all expense accounts always increase on the debit side. Cash is an asset and it is decreasing, and all assets decrease on the credit side. So our entry for this is on September 15th. We're going to debit salaries expense for $1,430. We're going to credit cash for $1,430, and we are going to denote that we paid employee salaries. On September 17th, Adams Family Counseling is going to receive a $1,400 cash payment from the Gomez family for services provided on September 10th. So on the 10th, we performed counseling services and we billed the Gomez family. And now the Gomez family is sending us the money that they owe us that we billed them for. So they are getting out of debt to us. We're getting the money we've been eligible to receive for the last week in this case. What accounts are being affected? Well, firstly, what are we receiving? We're actually getting paid, so cash has to be one of those accounts being affected. The Adams family no longer owes us this money. We're no longer eligible to receive any money from them because they have paid off their debt to us, which means accounts receivable, or AR, has to be the other account that's being affected. They're paying off their debt. What type of accounts? They are both assets. We're getting the cash, which means the company's cash account is going to increase. The Gomez family is not going to owe us money anymore, which means the amount of money that we are stated and waiting to receive from other parties has to be going down because they no longer owe us this cash. What side do these accounts increase or decrease on? They're both assets. Assets go up with a debit, down with a credit. So the entry on September 17th is to debit cash for $1,400 and credit accounts receivable for $1,400, and we receive payment from the Gomez family for prior services. Next up, on September 20th, Adams Family Counseling is going to perform $450 worth of services for the Charles family. The company billed the customer and will be paid at a later date. Well, this is the same exact thing that happened with the Gomez family earlier, and this happens in accounting. You're going to see the same entries over and over and over again where you'll just get them ingrained in your brain. This entry is going to be exactly the same as the last one, just for a different amount of money. So what accounts are being affected? We're not getting paid because we're billing them for later, so accounts receivable, the amount of money people owe us, is going to have to change, and the account that tracks the amount of services that we provided during the period also going to change. What type of accounts? AR is an asset. Service revenue is a revenue account. Are they increasing or decreasing? Well, accounts receivable is going to be going up because now other parties owe our company more money. We're eligible to receive an extra $450 from other parties because we just performed these services for the Charles family. But we did the job, which means we get to recognize the revenue at the time that we did the job. So we're going to increase our service revenue account. What side? Assets go up with a debit. Service revenue is a revenue account. It's also going up, and all revenue accounts go up with a credit. So the journal entry is the same we had last time. Debit to accounts receivable for $450, credit to service revenue for $450. We performed services on account. On the 25th, we were paid $2,600 in advance by the Wednesday Community Center for services to be performed in October. And this is a different situation because we haven't done the job yet. We got paid in advance for something that we are going to do later, which means we owe something. We owe the Wednesday Community Center the services that they have already paid us for. And since we owe somebody something, we have a liability. What accounts are going to be affected? Well, cash is going to be affected because we are getting paid in advance, but we haven't done the job yet, so we can't record it as revenue. We're going to have to record the fact that we owe those services to the Wednesday Community Center, which means it's a liability. And that liability isn't any type of earned revenue account. We're going to call it unearned revenue. So cash is an asset and unearned revenue is a liability. Unearned revenue is one of the few liabilities you're going to come across in your first couple of accounting classes. It doesn't actually end with the word payable, but it is still a liability because you owe somebody work. Are they increasing or decreasing? We're getting the cash now, so that's going to go up. And the amount of things that we owe to other parties is now also increasing, because now, in addition to what we owed before, we also owe the Wednesday Community Center this $2,600 worth of work. Cash is an asset. Assets increase on the debit side. Unearned revenue is a liability. Liabilities increase on the credit side. So the journal entry on September 25th is to debit cash for $2,600 and to credit unearned revenue for $2,600. And we received advance payment for future services. On September 28th, Adams Family Counseling is going to be paid $2,200 in cash for services that they provided to the Aston family. It's the same as an entry that we saw before. The entry is always going to be the same every time that you provide a service and are paid at the time that service is provided. The two accounts being affected are going to be cash and service revenue. Cash is an asset. Service revenue is a revenue account. Are they increasing or decreasing? You're getting the money at the time of services, so your cash account has to be going up, and you actually provided the services, so the amount of services that you have provided during the period in total also has to be increasing. Assets increase with a debit. Revenues increase with a credit. So the journal entry on September 28th to record this would be a debit to cash for $2,200 and a credit to service revenue for $2,200, and we performed cash services. On the 29th, Adams Family Counseling paid $1,200 in advance for a 1-year insurance policy. This is not uncommon. Typically, companies will give you a discount if you prepay a long period in advance. I once kept books for a not-for-profit where they paid their rent 6 months at a time, because if they did so, the landlord charged them 10% less per month for prepaying for their rent. So that's what Adams Family Counseling is doing here. They're paying for an entire year's worth of insurance up front, because this insurance policy doesn't become effective until October 1st. So what accounts are being affected? We can't record the expense for insurance, even though it's a necessary cost of this, because it's not the period that we're using it. We're paying in advance for this insurance to be used later. So we can't record an insurance expense. Instead, we're going to have to put it into an account called prepaid insurance. But we're sending out the money right now for the entire year's worth of insurance, which means our cash has to be effective. What type of accounts are they? Prepaid insurance is something that we're going to use that's necessary to help us make a profit in the future. Just like cash, it is an asset. Is it increasing or decreasing? Well, the number of months that we have our insurance prepaid for on our books is going up because we just bought more prepaid insurance. And cash has to be going down. They are both assets, and we know that assets increase with a debit and decrease with a credit. So the journal entry to record the September 29th transaction is to debit prepaid insurance for $1,200 and to credit cash for $1,200. We prepaid for 12 months of insurance. Next up, on September 30th, Adams Family Counseling paid the company assistant her $1,430 biweekly salary in cash. We've already seen this transaction. And if you'll recall, the two accounts being affected are salaries, expense, and cash. We get to record the expense right now because we're paying for necessary business operations that have happened within this period. Our assistant actually worked in September, so we get to record the expense right now. What type of accounts are these? Expense for salaries, expense. Asset for cash. Are they increasing or decreasing? Well, the amount of salaries we pay during the period is going up, and the amount of cash we have is going to be going down. Expenses increase with a debit. Assets decrease with a credit. So on September 30th, we're going to debit salaries expense for $1,430. We're going to credit cash for $1,430 because we paid employee salaries. Next up, on September 30th, Adams Family Counseling is paying their September rent of $800 in cash. So we're paying our rent for this period, for September. We're not paying for rent in future months, which means since it's for the period that we're keeping books for, we're not prepaying. And if we're not prepaying, we can recognize it as an expense. This is an expense for rent. So rent expense is one of our accounts being affected. And we're actually paying for the rent, so cash has to be the other one. Rent expense, obviously, is an expense account. Cash is an asset. Are these accounts increasing or decreasing? Well, rent expense tracks how much rent we paid during the period. And since we just paid our rent, it has to be going up. And our cash has to be going down because we just paid our rent. Expenses increase with a debit. Assets decrease with a credit. So the September 30th entry for Adams Family Counseling's payment of rent is going to be a debit to rent expense, $800. Credit to cash for $800. We paid our September rent. On September 30th, Adams Family Counseling receives a $200 utility bill. This bill is for utilities that we used in September, but are going to be paid in October. Again, this is September. We use that electricity, whatever, for the utilities during September, which means we get to recognize the expense of this bill in this month because it's during the period that we actually used it. So utilities expense is going to be one of your accounts. But we're not actually paying for it yet. We're not paying till October, which means no cash is changing hands. But we know we owe it. And if we owe something, it's going to be a payable. And this payable is for utilities. So our other account is going to be utilities payable. What type of accounts are these? Utilities expense is an expense. Utilities payable is a liability. Are they increasing or decreasing? Well, the amount of utilities that we incurred that we're going to have to pay for during the period is going up. The amount of money we owe for utilities to other parties, since we just got a new bill, also has to be going up. Expenses increase with a debit. Liabilities increase with a credit. So the September 30th entry for the receipt of this utility bill is a debit to utilities expense for $200 and a credit to utilities payable for the same amount. We received our September utility bill. Also, on September 30th, Adams Family Counseling's owner, Gene Adams, is going to withdraw $2,900 from the business for his own personal use. If an owner is going to use business funds for an item that isn't going to be used by the business, like they want to take it out to go on vacation or something along those lines, they have to first formally withdraw it. Let's say that Gene Adams... Additionally, on September 30th, Adams Family Counseling's owner, Gene Adams, is going to withdraw $2,900 from the business for his own personal use. If an owner wants to use business funds for his or her own personal use, they need to first formally withdraw it from the business. Let's assume, for levity's sake here, that Gene Adams is going to buy a jet ski with his $2,900. Well, what good is a jet ski to a family counseling business? There's no reason for it. And it would be disingenuous and also super illegal for them to put it on the books as a business asset when that asset has no business purpose. So we can't just put this jet ski on our books because it's not a business asset. In order to acquire, Mr. Adams needs to take money out of the business so he can use it for his own personal use. So the first account being affected is Adams' withdrawals. And what is he withdrawing from the business? He's withdrawing cash. What type of accounts are these? Well, Adams' withdrawals is a withdrawal account. Cash we know is an asset. Are they increasing or decreasing? Adams' withdrawals tracks how much money this owner has taken out of the business. And since there's more withdrawals going on after this transaction, the total amount of withdrawals that Mr. Adams has made during the period is going to be going up, and the business's cash is going to be going down. Withdrawals are going to increase with a debit, and assets decrease with a credit. So the journal entry on September 30th is to have a debit to Adams' withdrawals for $2,900 and a credit to cash for that same $2,900. And the owner withdrew funds from the company bank account. After we've gone through all of our journal entries, we need to make our T accounts. And I personally, as I do this, move to the T's as soon as I make the journal entry. But I've been doing this job a while, and I find that most students prefer to do them at the end of the period, to do all of the journal entries and then go on to the T's. Whatever way makes you happy. Pearson has it set up so you have to do the journal entries first, which is why I've done it this way. But you do have the option of just, every time you record a journal entry, immediately putting it into the T's. Choice is up to you. So we have this T account for cash. How are we going to figure out the balance? Well, we have nothing in the beginning, let's assume, because there's nothing that told us there was a beginning balance. Then we're going to go through every journal entry, and we're just going to move whatever happened to cash in that journal entry to the T account. So on September 1st, we had a debit to cash for $42,000. In the September 6th journal entry, we had a debit to cash for $1,800. In the September 7th journal entry, we had a credit to cash for $21,000. So on and so forth. We're going to go through and we're going to just take whatever happened to cash in each journal entry, denote its date, and at the end we're going to have all of this information in our T account. How do we find the balance of the T account after we have all of the cash entries from the journal entries moved over to the T account? Well, cash is an asset, and assets go up on the debit side and down on the credit side. So if we add all of our debits and subtract out all of our credits, we're going to find out that we have a balance of $19,640. Because debits were more than credits, it's going to be on the debit side, and it should normally be, because if you had a credit balance of cash, that would mean you would have negative cash, and that doesn't really work out so well. So cash should always have a debit balance, as should all assets. And just like we figured out cash right there, we're going to figure out the balance of all of our T accounts. For all assets, withdrawals, and expenses, we're going to take those numbers, we're going to move them into the T accounts, and then at the end we're going to add all the debits and subtract all the credits to find our balance. For liabilities, equity accounts, and revenues, again, we're going to take all the numbers out of the journal entries, and when we find the balance of the T, we're going to add all the credits and subtract all the debits. And I have done that here because this would be a really long video if I had to go through journal entry by journal entry. So I went through and I found the balance of all the different accounts that we use by taking all of the information right from the journal entries and putting it into the T. And now that we have the balance of all of our T accounts, well, we can make our trial balance. Cash was the first one that we had, was $19,640. Accounts receivable had a balance of $650. Supplies had a balance of $400. Prepaid insurance had a balance of $1,200 on the debit side. Land had a balance of $21,000 on the debit side, and furniture had a balance of $1,600. Those are all our assets. Next, we go to our liabilities, and accounts payable had a balance of $400. Utilities payable had a balance of $200, and it's a credit because it's a liability. And unearned revenue had a balance of $2,600. On to our only equity account, which is Adams Capital, which has a credit balance of $42,000. And then on to our only withdrawal account, Adams Withdrawals, which had a balance of $2,900. Our only revenue account was service revenue, and it ended up having a balance of $6,050. And then we had three expenses. We paid $2,860 worth of salaries during the period. We paid an $800 rent expense, and we received that $200 utility bill. Do our debits equal our credits? Well, we add up all our debits, and when that comes up to $51,250. Then we go through and we add up all our credits. Also comes out to $51,250. And since we have that debit credit equality, both numbers are the same, we know that our trial balance is ready to be used to prepare our financial statements. Good luck on your quiz, everybody.